Good afternoon. This is the Asymmetric Daily Brief for Thursday, August the 13th, 2026. Today, the S&P 500 traded above 7,800 for the first time in history, an intraday record of 7,808. And the story everybody told about it was that inflation has been beaten. Here is what did not make the headline. Over the last 12 months, the prices businesses pay rose 4.7%, while the prices consumers pay rose 3.4%. That gap is companies absorbing costs they cannot pass on. On the same day, the most capable artificial intelligence model on the market was matched by a rival charging more than 60% less, and the leading laboratory was reported to be spending $6 billion to buy a company that makes chips cheaper to run. 3 arenas, 1 mechanism. Pricing power is being competed away. That is the brief. Let's walk it. The board, the S&P 500, set an intraday record of 7,808, the first time it has ever traded above 7,800. Worth noting, that level was the year-end target for both JPMorgan and Morgan Stanley, so the index reached in August where Wall Street expected it in December. Underneath that record, concentration keeps climbing. The 10 largest companies now account for more than 40% of the entire index by weight, against a historical average closer to 24%. In rates, Tuesday's 10-year Treasury auction cleared at 4.683%, the highest since 2007, and it cleared above the level the market expected, which we will come back to. Gold sits around $4,395 an ounce, with the dollar index slipping below 100, and as always we quote the level and the dollar driver rather than a contested percentage. West Texas Intermediate crude is near $82, down between 1 and 2%. And Bitcoin is around 63,400, with its daily, weekly, monthly, and yearly trends all negative at once. The board disagrees with itself today, and that is the most useful thing about it. Start with the report that actually moved markets, because the good news in it was genuine. The Producer Price Index for July came out this morning, and on the month, final demand was unchanged, flat. Prices for final demand goods fell 0.7%, services rose 0.2%, and more than half of that decline in goods came from a 5.7% drop in gasoline prices. So on a month-over-month basis, that is a soft report. And combined with crude oil falling again, it is entirely reasonable that equities took it as relief. That is the number that produced the record high. Now hold that thought, because the same release contains a second number and it points the other way. Over the 12 months ending in July, producer prices for final demand rose 4.7%, and prices for services feeding intermediate demand, which is the cost of doing business one step up the chain, rose 5.1%. Set those against consumer inflation, which came in yesterday at 3.4%. So the cost of inputs is running more than a full percentage point hotter than the price of outputs. That difference does not vanish. Somebody is absorbing it, and that somebody is corporate gross margin. It will not appear in any inflation statistic. It appears a quarter or two later, quietly, as guidance revisions. That is the single most undercovered number of the day. Which brings us to the first of today's contrarian reads. Consensus says inflation has cooled, so the Federal Reserve is finished. Yesterday's consumer report supports the first half of that. Headline inflation came in at 3.4%, core at 2.5%, both a tenth lower than June, both right on expectations, and core is now at its lowest in 5 months. The reflex conclusion is that rate cuts are coming. Now go and look at what is actually priced. The live debate is not about a cut. It is about a hike. Market-implied odds of the Federal Reserve raising rates in September sit somewhere between 40 and 50%, depending on which venue you read. Bloomberg's bond coverage described traders as keeping a coin toss wager on a September hike, even after the tame print. A cut is not on the board at all. So we have an index at an all-time high, while the serious argument in the next room is whether policy gets tighter in 4 weeks. Both of those things can happen. They cannot both be right for very long. That is high conviction, and it is the most mispriced setup on the tape today. Second contrarian read, and this is the one we take apart properly in today's Focus episode. Consensus says the new Grok 4.6 release means there is a new leader in the artificial intelligence race. The tape says something far more interesting. It means the model layer has run out of pricing power. On the Artificial Analysis Intelligence Index, which is the industry's public scoreboard, Grok 4.6 scores 61. Claude Opus 5 scores 63. Claude Fable 5 scores 62. And GPT 5.6 Sol also scores 61, an exact tie. So the distance from first place to fourth place is 2 points. That is not a technology race with a runaway winner. That is an industry, and industries compete on price. Here is the price. Grok 4.6 charges $2 per million input tokens and $6 per million output. Claude Opus 5, 2 points ahead of it on the index, charges $5 in and $25 out. GPT 5.6 Sol, tied with Grok on capability, charges $5 in and $30 out. That is better than 60% cheaper for a product 2 points behind. And I want to be precise here, because a widely shared version of this claim put the discount at 85%. That specific figure is not independently confirmed against the published rates, so we are not using it. More than 60% is confirmed, and it is more than enough to make the point. Now the confirming evidence from the other direction. Anthropic, the laboratory holding that 63, is reported to be in talks to acquire a company called Descartes for about $6 billion. Those are talks, not a completed deal, and it may not happen, but it would be its largest acquisition ever, at roughly a 50% premium to the $4 billion valuation Descartes carried in May. And what Descartes sells is not a model. It is software that makes chips run artificial intelligence more cheaply. When the intelligence leader spends a record sum on cost of goods, months after filing confidentially for an initial public offering, it is telling you where it believes the margin actually lies. The third contrarian read. Consensus says tokenized stocks are the future of market structure. The proposal in question is the so-called innovation exemption being prepared under Securities and Exchange Commission Chair Paul Atkins. It would let publicly listed shares trade as blockchain tokens around the clock, in fractional sizes, with near-instant settlement. Now read the fine print, because it is doing an enormous amount of work. The exemption explicitly excludes voting rights and dividends. Strip out the vote and strip out the cash flow, and what you are holding is not equity. It is a 24-hour price-tracking derivative on equity. That may well be a product people genuinely want. The retail tokenized stock market has gone from effectively nothing at the end of 2024 to more than $6.4 billion by the middle of June. But it should be understood and priced as what it is. Medium conviction on this one, and the thing to watch is whether that sandbox stays narrow or quietly becomes the default venue. Now following the money, and the first place it leads is the long end of the bond market. On Tuesday, the Treasury auctioned $42 billion of 10-year notes. The auction cleared at a high yield of 4.683%, the highest since 2007, and it tailed, meaning it cleared slightly above the level the market was quoting beforehand. A tail sounds technical, but the meaning is simple. Dealers had to absorb paper the market did not want at the screen price. That happened in a week that also carried a 30-year sale, heavy corporate issuance, and a government financing requirement that is not shrinking. Softer consumer inflation does not fix a supply problem. Duration is being repriced on its own schedule, and the equity market is not participating in that conversation at all. Next, the dollar and the metals. The dollar index slipped to 99.87, back below the 100 handle, and gold sits around $4,390 to $4,400 an ounce, with December futures near $4,469. This is a currency trade wearing a metal costume. When the dollar leaks, the metal bids. And notice what is not happening alongside it. The debasement bid is going to gold, and conspicuously not to crypto, which brings us to the split inside crypto itself. Bitcoin is near 63,400 with its daily, weekly, monthly, and yearly trends all negative simultaneously, which is a rare 4-time-frame alignment and not the good kind. Ethereum, on the same day, went from $1,878 to $1,983, up 5.6%. A 5-point single-day divergence between the two majors is not beta. That is a rotation. Whether it is a durable one is genuinely unresolved. A word on positioning and sentiment drawn from market and social sentiment monitoring. The dominant conversation today is celebratory, and it is running in one direction, that inflation is falling and therefore the Federal Reserve is about to ease. That framing is measurably wrong on the second half. The pricing shows a September hike as close to a coin toss and a cut essentially absent. There is also a good deal of enthusiasm around the new model release framed purely as a capability win, when the more consequential fact in it is the price. And the most under-discussed item of the day, by a wide margin, is the producer price gap we opened with. When the commentary and the pricing disagree this cleanly, the pricing is usually the one worth trusting. Sectors in play. First, energy, which is currently arguing with itself. Crude fell on a United States inventory build of 17.4 million barrels for the week ending August the 7th. The week before, the build was 2.5 million. That is an enormous move. And yet in the same window, the International Energy Agency's monthly report put the global market at a shortfall of 1.8 million barrels a day this quarter, with the Middle East conflict ongoing. So we have a visible glut and a projected deficit in the same week, and the market is currently voting for the barrels it can see. That is volatility, not direction. Second, artificial intelligence infrastructure. The bull case is that every efficiency gain expands the workload the world can afford to run. The bear case is that if the model layer's margin compresses, the capital spending funding all of it starts getting scrutinized. The read is that value is migrating from the model to whatever makes the model cheap, and that is a different set of companies than the headlines are following. Third, rate-sensitive equities. Consumer inflation is decelerating for a second month, which is the bull case. The bear case is a 10-year clearing at the highest yield since 2007 with a live coin toss hike. Discount rate risk to the upside, multiple at a record. That is an asymmetry and not the friendly kind. Tell, producer prices up 4.7% over 12 months. Consumer prices up 3.4% over the same 12 months. That 1.3-point wedge is the entire issue in a single line. Costs into the business are climbing faster than prices out of it. When that persists, it does not show up as inflation. It shows up as margin compression. Now hold it next to the artificial intelligence story. Frontier capability separated by 2 points. Price separated by more than 60%, and the leader buying cost efficiency at a 50% premium. Same shape, different arena. Pricing power is the scarcest asset in this market, and almost nothing is priced as though that is true. On the radar, first, September the 15th at 2:15 in the afternoon, when the cloture motion on the crypto market structure bill becomes eligible for Senate action. Be precise about what that is. Cloture on the motion to proceed is the first procedural step, not passage. The bill remains stuck on ethics, conflict of interest, and illicit finance provisions. What changed is that every senator now has to take a recorded position rather than letting it expire quietly. Second, the September Federal Open Market Committee meeting, where a hike is a live coin toss and a cut is not priced. Third, the July personal consumption expenditures report later this month, which is where the producer versus consumer wedge either shows up or does not. Fourth, the Anthropic public offering process, with a confidential filing lodged in early June, which makes the Descartes talks a pre-offering margin story rather than a product story. Fifth, weekly crude inventories, because a second 17 million barrel build breaks the shortage narrative outright. And sixth, the next long-end auction. Another tale at 2007 yields is the duration warning getting louder. The scorecard, where we log dated calls that can be proven wrong. 3 new ones today. 1. By the 13th of November, at least one additional frontier tier model, meaning top 5 on the intelligence index, launches at or below $3 per million input tokens. That is falsified if no such launch occurs. 2. By the 13th of November, the producer versus consumer inflation gap narrows below 1 full percentage point, or third quarter margin guidance revisions skew negative. Falsified if the wedge holds above 1 point and guidance skews positive. 3. Market implied odds of a September rate hike remain above 25% entering the meeting. Falsified if those odds collapse below 25. And carried forward from prior issues, the duration and supply thesis has now been reinforced twice in a week. Tuesday's tale at 2007 yields is direct confirming evidence. That call stands unchanged. Close. The market spent today celebrating a producer price report whose 12-month number was 4.7%. So the question worth sitting with is this. If pricing power is being competed away at the loading dock, in the model layer, and now by regulatory design out of the very definition of a share, what exactly is a record high multiple paying for? We are watching the September 15th clock, the next long-end auction, and whether anybody else notices the wedge. Today's Focus episode takes the artificial intelligence side of this apart in full. This is research and education only, it is not financial advice. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe.